So welcome to Trading Options 101. With volatility coming back into the stock market, options is definitely something to utilize, especially in short run trading. So it's something that isn't really talked about a lot. If you turn on the news, no one really talks about options trading. It's just your basic stocks and things like that. So we were going to go over a couple of different things here as far as basic options, what they are, the different kinds of contracts. And then I actually have a video that we're going to go over and we can chat about it and break it down. So let's go ahead and get rolling. So we are going to pull up this slide right here. So it's basically just how do put and call options work. So there's two different kinds of options. We have a call and we have a put. So essentially, let's see here. We have our call options. We're going to put those in red. And then we're going to put our put options in blue. So let's start off with the call option to begin with. So a call option is an options contract, gives the buyer the right to buy the underlying asset at the strike price at any time up to expiration date. So when you think of call, think the term right to buy. And a put option is the opposite of that, which is the right to sell. So basically, with a call option, it gives you the right to buy that option at the underlying strike price at any time before, up to your expiration date of the contract. So a contract, think about a contract in terms of sports. Tom Brady, Patriots, his contract expired. So think of contracts as being able to expire. So options are contracts that expire, which gives them a lot more risk associated with them than just buying a stock. You could buy a stock and hold it for eternity. You never have to sell it. With an option, it's a contract. So a contract is something that is has a shelf life. It's going to end. So before it ends, one of two things happens. Either you're going to make money and you're going to exercise your option before it comes to date, or you're going to be out of the money, you lost, you're going to let it expire, and you're going to take your L, you're going to move on. So let's talk about call options first. So call options are the right to buy at any time up to the expiration date. So call options, think you want the stock, if you buy it, to go up in value. So you want to buy the stock. So if you buy a stock at $10, it goes up to $100, you're going to want to right to buy that stock at the $10 so that you're going to exercise it because you're going to have all of that profit. A put gives you the right to sell. So when you want to sell, think sell equals short. So short sell, sell short. They both start with the letter S, and it gives you the right to sell. With a put option, when you buy a put option, you want it to go down in value. So let's talk about this, because if we can understand these two theories here, then it's going to make options very, very easy. So here's a good indication here. We got calls, buy a call, right to buy. And all of these handouts, I put them in the webinar, so you'll be able to download them for your files or whatever you want to do with them. So calls, buy call, right to buy put, right to sell, call, sell call, obligation to sell put, obligation to buy. So these are just the inverse of each other. So if we know what a buy a call is, the opposite of a buy a call is buy a put. And if we sell a call, the opposite is sell a put. So let's break that down. So buy a call, we want the price to go up. So let's go ahead and draw on here. So drawing here. So we want the price to go up. If we sell a call, we want the price to go down. We buy a put, we want the price to go down. If we sell a put, we want the price to go up. So I would recommend printing out this chart, writing it down, and figuring out, if you know what a buy a call and buy a put is, it's going to be very easy to figure out the opposites because they're just inverses of each other. If you have any questions, put them into the chat. I may go, if I go too fast, tell me to slow down. If you tell me I'm going too slow, just tell me to speed it up. I first learned about options when I was at Florida State doing actuarial science. So this is very intuitive for me to know buy a call up, buy a put down, and it's very intuitive. So let's see here if we can make this bigger. So let's remove this and let us go to time decay. So let's talk about time decay because these are contracts and they have a shelf life. So this is showing how it works. So as you can see here, it's going down, 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 down. So in the beginning, you don't have time decay, but as we get closer to expiration, you can see here, this is your access, this is your access. Once we get to the expiration, your contract is worthless, no matter what. You could be up 10 million% on your contract, and if you let it expire and you do not exercise that contract, you are not going to make any money because a contract expires. So that's very important to think about. So let's take a look here. So let's open a whiteboard. So let's say we buy a call option for $10. So, and then let's say the stock price goes to $20. So we buy a call option for 10, stock price goes to 20. So we are in the money. But remember, there's actually a cost associated with buying an option. Let's say that is $5. So we would be in the money by $5 because we bought for 10, it cost us 5. So 10 plus 5 equals 15, and the price is 20. So that means we're $5 in the money. If you let the contract expire, it goes to 0. No matter what. No matter what. So we need to be very, very aware of that. So let's go back here to the time decay. So we have as much time between when we buy it to when we sell it to exercise the contract, even if it's at a loss. If it's at a loss, you would just let it expire, so it goes to zero. But if you're in the money and you let it expire, it still goes to zero. So you need to be very aware of that. So let's just pause here. I'll see if you guys have any questions. Please put them in the comments. And I'm just gonna stop and take a minute here to let that marinate. So let's go over a brief summary here on our whiteboard. So call is right to buy. We want the price to go up. Put is right to sell. We want the price to go down. This is all I'd be concerned about you learning, because everything is extremely intuitive from there. So if you know what a call is, right to buy, price goes up. Put is right to sell, price goes down. So if we sell a call, obligation to, let's see, make sure I get this right. So sell a call, obligation to sell. So it's the opposite of buy. So that's what I want us to learn here, is to think about it intuitively. So call is right to buy. You sell a call, let's bring this here. Sell call is obligation to sell. Sell put is obligation to buy. And if you sell a call, you want the price to go down. If you sell a put, you want the price to go up. So it's all opposites. So that's why it's important to know trying to get the circle to work, but it's not working. It's all good. That's why it's important to know this side is more important. So call is right to buy, price goes up. Put is right to sell, price goes down. If you know those two things, everything else just is the opposite. Sell a call, down, obligation to sell. Opposite of up is down, opposite of buy is sell. Obligation to sell is opposite of right to buy, and vice versa. So Alex had a question. Let's go back and go to the whiteboard. So let's just say we buy, do an example where we buy a call. The right to buy. We want the stock price to increase. Say we buy it at $10 and it costs $3 to buy the option. So in order for you to break even, our break-even point, break even equals $13. Is equal to the option plus the cost of option. So everything above 13, so anything greater than 13 is considered in the money. And that's how our option work. And then you're given your parameters. So whether it's a 6-month, 9-month, 2-month, 3-month, 1-day option, That's where the time decay comes into play. So Alex had a great question. In a few weeks, the way the markets is, it would be better to work with puts. So let's talk about puts. So if you buy a put, obligation to sell, you want the stock price to go down in value. Let's just say we buy stock ABC. We split this. We buy it for long or buy a put at $10 with price of $2 per contract. Our break even equals $8 equals 10 minus the $2. So we want this price to go below $8 for puts. And it's per 100 shares, which equals one contract. So it's always easier to think of a contract just as one, but when you're in the grand scheme of things, 100 shares, one contract. But for this, keep things simple, it's always easier to work with the smaller numbers. So let's just say you decide to buy stock ABC for $12. And you're long, which is the same as buy. But you're unsure of what's going on in the short run, so you decide to buy or long a put. There's obligation to sell for $10, and it costs you $2 to buy the contract. Stock price goes to $4. So here, you're at a loss. Loss of $8 a share. Here, your gain of $4 a contract, because break even is 8 minus 4 is equals $4. So if you buy a put in the short run and the stock price goes down, so on the left side here, let's make this color black. Oops. On the left side here, we have a loss of $8 a share. But in the long run, we believe ABC stock is going to do well. So we buy a put to take advantage of the short term that the price of the stock goes down. And then we exercise our option because it would be in the money. So we'll make it green for in the money. That's not green. Green. So this one's in the money. So let's talk about that. So we are at a $4 loss with ABC stock. And let's just say they had bad earnings and we decide to double down. So we buy, let's say, 2 shares at $4 share. and we originally bought one share at $8, which is now worth $4. So we now have 3 shares at 4. We have 2 shares bought at $4. We have 1 share bought at 8. So this is called basically doubling down. We're buying 2 shares that are equal to the original $8 that we buy. So what this is going to do is it's going to reduce our cost basis. So one of 2 things can happen at this point in time. Let's just say ABC stock, we want to exit and then sell the shares for a loss. So by buying at the lower price and then immediately selling, it limits our losses. So that's one way to exit the position. Or we hold and doubled down at the lower stock price. You're basically leveraging your position. We picked a point in time, we bought it for 8. It went down to $4. So we bought 2 shares at the $4, which equals our original 8. So that allows us to do one of 2 different things. We can either go here, sell, exit the position. Since we added more money to our position, that's going to minimize our losses, and then we didn't exit the position. Or we do this option here where we double down and leverage our position. So that means for every $1 of increase, the original next shares that we bought, the 2 shares, is going to double our gains as the stock price goes back up in value. So those are 2 different options for you to look at. Maybe you have a position you don't like, you decide to either double down, exit it. It'll minimize your losses for tax purposes as long as the money is in a non-retirement account. Or we double down, hold for the long run, and then things are good there in that situation, and that's what we all hope for. So what I got next is a video I'd like to share. Talks about implied volatility. We'll go over it together. I'm going to pause and stop it as we move forward. I'm just going to go ahead and stop here, see if you guys have any questions before we move forward. So I'm going to wait about 30 to 40 seconds to see if y'all got any questions before we continue. So Nick's good. Question, Alex, anything? All right, so no questions. Let's go ahead and talk about this video here.
First learned about options, you probably learned about the option Greeks. Delta, gamma, theta, vega, and rho. From there, you probably honed in on delta. That's because many of the most commonly taught option strategies are driven primarily by the direction and the price of the underlying. But if you're only focusing on price moves, you may be missing out. If you want to create trades with more flexibility and precision, implied volatility can be key. It can help you choose strategies and see trade opportunities beyond price movement. Consider the downtrending stock XYZ. An option trader wants to make a bearish trade.
All right. So this was Alex's question. So we have a downward trend. So let's see if I can write on here. No, doesn't look like I can write on here. But we have a downward trend. So if we have a downward trend and we anticipate things to bounce back, we would want to be longing or buying a call, which means we want the price to go up. If we think things are going to continue to go down, we're going to give, we're going to long or buy a put, which gives us the option to sell, the right to sell. So let's see what our friend says here.
He might consider buying a put or selling a call. Both are traditionally bearish strategies that are designed to profit from a downward price move. For the purpose of this example, we'll hold off analyzing factors like cost and risks and use implied volatility to help assess which trade might be best. Generally speaking, short option strategies like selling a call can benefit from falling implied volatility. This makes sense since these trades have negative.
So buying a put and selling a call, we want the same thing to happen. So if we buy a put, we want the price to go down. Selling a call, we want the price to go down. So this is showing the differences between why you'd want to do both options. Both options want the same outcome, but they work a little bit differently. So let's continue here.
Negative vega, and the goal is usually for the price of the underlying to stay below the call strike, in hopes that the option will expire worthless. On the other hand, long option strategies like buying a put can benefit from rising implied volatility. The goal is for the long option to gain value.
So, as it's showing here, if we have higher volatility, or what volatility means, just changes in the market. So we're having lots of changes, up, down, up, lots of swings in the market. Long a put would be better. If we short a call, that means we're selling. So short is selling a call. We want the person not to exercise. So we want the price to go down. The person who we sold that contract to, they're not going to exercise because they're not in the money, and then we end up winning. So let's continue.
And these trades are vega positive. Before we check what XYZ's implied volatility is doing, remember this number is relative. Some securities or industries are more volatile by nature. Rather than look at XYZ's overall implied volatility, we'll want to focus on where it's trading within its own volatility range. Here we see XYZ is trading at the low end. It's more likely that implied volatility will increase from here than fall. And that would benefit long options. Plus, increasing implied volatility often accompanies downward moves in price. So this helps confirm our trader's bearish outlook. Based on these factors, our trader might decide to buy a put rather than sell a call.
So a bear means bear market, which is for people who think the market's going to go down in value. So longing and put means go down, and that means increased volatility. If we have less volatility in the markets, we would want to do the opposite, which the opposite of longing and put is selling a call.
We'll show how implied volatility can impact a more complex real-world example in a moment. But first, let's walk through how to evaluate implied volatility on an actual security using our simulated trading platform, Paper Money. To illustrate, I'll pull up a chart of Tesla. To look at the implied volatility of the stock, I can add a study. I'll click Studies, point to Add Study, then Volatility Studies. And finally select Implied Volatility. Here we can see how Tesla's implied volatility has oscillated. And we can analyze how volatility increases have corresponded with price moves. At the high end of Tesla's range, volatility is just over 0.5 or 50%. At the low end, it's around 0.3 or 30%. But as we discussed, implied volatility is relative. To show what I mean, I'll pull up another example. This time using Autodesk. Here, the highest point of implied volatility is around 60%. Based on the chart, it looks like Autodesk is trading at the upper end of its range. To get a more precise idea, I can go to the Analyze tab and look at the option chain. I'll scroll down and click today's option statistics. Here, I can see the range of Autodesk's implied volatility over the past year, including that high of just over 0.6. I can also see that as we noted on the chart study, Autodesk is trading near the upper side of its range, in the 68th percentile. If I wanted to open a trade on a stock that is trading near the top of its volatility range, I'd consider a short option strategy that might benefit from falling implied volatility. Now, let's apply all of this to a more complex trade. I'll pull up a real example of a long call diagonal.
So that was just an example of looking at volatility. Are they these? So think or swim. What do you mean by that, Nick? Think or swim. Think we're just guessing or using statistics. Oh, I don't know. I don't know what trading platform. It looked like something proprietary.
Autodesk is. I can see the. I'll scroll down 60% discussed and related. Point to add study in our simulated trading implied volatility. Here.
So I can't really tell, but let's just look. I'm gonna pull up something on Yahoo Finance where we're just gonna look at the Dow Jones. I can pull up screen share. So let's look at the last 1 year of the Dow Jones Industrial Average. Just follow here. So if we are right here and we bought a call option, so look at the date. So the date is 5/31/2019. And here's the date is (2/19/2020). So if you would have bought a call option 5/31 and exercised it before 2/19, we would have been in the money. We still would have been in the money until about 3/6. So May 2019 to 3/6/2020. We got June, July, August, September, October. It's about 10 months. Let's look at the last 3 months. 1 month. 3 months. So as you can see, we were very flat, and then we went down, 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 down. So basically, we are here. So we are back in 2017 prices. We've dropped as low as 2016 prices. So to put in perspective, let's go more to the right. Can we go more to the right? So yeah. So this is where we dropped to, was about here. 2008 was all the way down here. So we have a long way to go till then. So as you can see, here's our current bottom of recent, was about to 2016. So if you look at this upper right quadrant, it gives you an idea of, if you work with these parameters, you can think, you would say, hey, in the short run, we would either want to buy a call or sell a put if we think it's going to go up. Or if we think it's going to go down, we would want to buy a put or sell a call. So that just gives you an idea of the chart of where we're at. And looking here, we go back to the early 90s. We went to 1999. Lots of volatility. So lots of volatility is good for people who are actively contributing, bad for retirees. Then we finally broke out. But look here, 2005, early 2000s, we really didn't have a lot of growth. Volatility was much higher back then than it's recently been for us. So that's where options trading can benefit you if we can figure out what we're doing. So let's stop sharing the screen and go back to our video of our friend. Can you tell us, so Alex had a question, can you tell us what you would do with the Dow as an example? Yeah, we can do an example. So if I'm basing my bottom to be about here, so that's 11/28/2016. You'd want to do a couple of things. So if you're going to long stocks, so if you're a long stock holder, so you're buying and holding stocks for the long run, and when I mean stocks, I don't mean options. In order to take advantage of the short run, to sort of hedge your bets. So if you're playing the long game, which means you want the price of stocks to go up, to hedge your bets, you want to play the down game. So that'd be the right to buy puts or sell call options. So if the stock price goes up, that's good for you because you own the stock. If the price goes down, that's good for you because you are buying puts and selling calls. As far as making recommendations on what to do, it's really like a coin flip at this point. As Warren Buffett said, active traders don't perform better than passive traders by about 2 or 3% per year. So you probably want to start with stocks that you believe in the long run. So whatever those stocks may be, let's just say you're holding ABC stock, but you think maybe in the short run things are going to be a little bumpy. You're going to want to buy puts. So buy puts and sell calls. So that means the price would go down. And that's just smart. There's going to be plenty of times where you buy a stock and it goes down in value as soon as you buy it. That's where you can utilize buying puts and selling calls to your advantage. But if you really want to roll the dice and play the long game on, things going up in value, then you would want to buy calls and sell puts. So let's see. Let's go back to our video here. I think he said he was going to do
options, you probably just over
lot
0.5 or
more of
50%. Based on the chart, just over 0.5 per side of it, consider a short option strategy.
Let's go.
That might benefit from falling implied volatility. Now, let's apply all of this to a more complex trade. I'll pull up a real example.
So this is going to be a complex one, so we'll probably go slow here.
This strategy is designed to work best when the underlying is trending sideways. So it should allow us to focus on the effect of implied volatility. A diagonal involves selling an out-of-the-money option and then buying an in-the-money option of the same kind with a further out expiration. It's a debit strategy. The long option drives the trade, and that means it should.
Okay, I'm going to stop there because it gets really complicated. And we want to keep things simple before we start doing these sort of strategies. So just to bring everything together here, the handouts for everything is in this webinar. So remember, a call is an options contract that gives you the right to buy, a put, a buyer, the right to sell. In addition to that, here's a good chart for you to know. Buy a call, you want it to go up. Buy a put, you want it to go down. Sell a call, down. Sell a put. Everything's an inverse relationship here. And remember, no matter what, contracts expire. So we have time decay. So if you're in the money, you need to make sure you execute those contracts. Otherwise, you are just throwing money out the window. But if you buy a loser, you just want it to expire and take the loss. That's all I had to go over today. questions about anything? Cool. So I'll let this marinate for a little bit, and perhaps the next time we get together, we can talk about combining call with put options, which is basically another way to hedge your risk. So you could buy a call and buy a put, and depending on how much you buy of each, that can allow an opportunity for you to make some money. And we can really show how putting the pieces of the puzzle together for the options is definitely a way to do it. So hit me up, Alex and Nick. I know both of you guys, you both have my number, so more. But I'm gonna